Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Hello, everyone. Welcome to the CFA Society India podcast. My name is Jolly, and I will be hosting today's episode. I want to start today's episode with a favorite quote of mine by Nassim Taleb. It says, invest in preparedness, not in prediction. And in that vein, in today's episode, we explore what does preparedness for the future possibly entail. And today we are in conversation with PRI. Joining me today is David Atkin. David Atkin is the CEO of the Principles for Responsible Investment. The PRI is a UN-supported organization with more than 5,000 signatories globally who collectively represent over US $121 trillion in AUM. He is responsible for the PRI's global operations. Most recently, David served as the Deputy CEO for AMP Capital, and before that, he spent almost 13 years as the CEO for CBIS Superannuation Fund. David has served on the board of the Climate Council. David was also the Australian asset owner representative on the PRI board. A very warm welcome, David. It is an immense pleasure to have you today.
Terrific to be here, Jolly.
Okay, David, firstly, I would like to know a bit about your career journey. You previously served on PRI's board. You worked with some of PRI signatories as well, and you also worked on several social issues as well. So it is wonderful how your work experience from the past is coming together, and each of that exposure goes a long way in your current role as well. So the dots connect really well. So if you could tell us about your passion about the responsible investment space overall.
Thanks, Jolly. So, where to begin? I worked coming out of university. I studied history and politics, so I'm a trained historian. Did a master's in history. I began my professional career working for trade unions in the 1990s, with a particular focus on the finance sector union. So I became very aware of the experiences of workers in the finance sector. Ran the national office for the national union in Australia, and then moved across into a cottage industry at the time, industry funds, the superannuation industry in Australia, which was established by legislation in the mid-1980s. By the early 1990s, it was beginning to form into sort of larger organisations, and I was very lucky to come across into the pension fund and learnt my trade there. I joined the fund's Superannuation Trust of Australia, which has now become Australian Super, which is the largest Australian pension fund, the 17th largest in the world and the fastest growing pension fund in the world. But when I started, it had 20 people, and it now has well over 2,000 offices in New York, London, around the world, China, etc. Wow. So that was very fortunate because I came in at a time where there was opportunity to learn about investments, about administration, about marketing, member servicing, but also most importantly around governance and the way in which the trustees thought about creating value for its members. And its workforce was primarily manufacturing workers. And so from there, I've learnt my trade, learned to understand the importance of ensuring that you understood all the issues that were associated with creating value for the people that you served. And then from there, I worked for three other super industry funds, the Journalists and Actors Fund, Emergency Services Fund, and then for 13 years, the CEO of CBIS, which is the Construction and Building Fund. CBIS is quite iconic in the Australian context because it was the very first fund to establish compulsory savings for super through industrial relations arrangements. And so what was quite formative for me when I was at STA in my very first role, which was a marketing communications role, was at that time, around the turn of the century, there was a phase of introducing sustainable, responsible investments onto your investment menu as choice for people to choose. If you wanted to do good as well as invest on, for returns. And we did some market research with our members, and we sort of will take them through, would you like to be allocating money into something where you can feel as though where you are doing some good for society, but you're also achieving returns? And the answer back was yes, of course we would. But then they said, which was quite, for me, informative. If you really believe, if the trustee really believes that these options are superior than the default, which everyone's put into, if they're not, they don't choose, then why are you making me choose? I'm a manufacturing worker. You're the experts in super. It should be part of your overall investment philosophy and your investment strategy. And so for me, that stayed with me because that made so much sense. If you really believe that these SRI options were superior, that should become part of your overall investment approach. So there's that factor. And then at the same time, around the turn of the century, we saw all the corporate collapses around the world, which were as a result of poor governance, conflicts of interest. We saw billions of dollars wiped off shareholder value overnight, both in Australia and globally. And there was, I guess, a period of introspection by the investment teams and trustees of the various funds to say, well, were we really missing in action? Were we probing enough in the companies that we were invested in to ensure that they did have proper governance arrangements in place? And I think that reverberated not only in Australia but around the world, because we then saw this growing awareness that there were these potential materialities that were not sort of obvious. And then there's another sort of factor here that I think is worthwhile mentioning, which is that I like to quote this research. So Ocean Tomo have been tracking the S&P 500 since the 1970s. And when they looked at the balance sheet in the 1970s, 80% of the value could be attributed to tangibles and 20% to intangibles. So research, brand, social license to operate, other non-mainstream financial issues. That research done now is the opposite. And so what that says is that there is all this additional information that's now really important to assessing the value of companies that's not captured by the balance sheet as we've traditionally seen it. And I think this is where the E, the S, and the G really come into play. That increasingly investors have recognised that there are material extraneous factors that could impact value and the share price, but by using traditional methods doesn't capture properly. And so from a risk return opportunity, by broadening out and looking and also thinking more long term, what are these long term issues that could play themselves out, that could impact? And then I guess the final thing to say is that from my own perspective as an executive working in these pension funds, we have an enormous responsibility to be able to take someone coming into the workforce. So, for example, in CBUS, if we did our job well, we would take someone in as a 16-year-old as an apprentice. We would keep them through their working life. Because remember, in Australia, if you don't like your fund, you can leave them at any point. But if you took them in at 16, we're able to help them save to create a retirement with dignity, and then take an income stream in retirement. They could be with you for 50, 60, 70 years. So how you think about materiality changes, how you think about value creation changes when you have to think about those different time horizons. And as we know, the financial system around the world is grounded in incentivizing short-termism. And so this is where I guess our industry, the responsible investment industry, is effectively trying to replumb finance. We are trying to imagine the way the balance sheet works by bringing in additional new insight, new information that could be material, and obvious issues like climate change are, the most obvious externalities that are impacting us, impacting your ability to invest. And so that, for me, that was sort of I guess, a run through of how I've got to this point, because I was then, when I was the CEO of CBUS, I had my team come to me and say, look, there's this new organization called the Principles for Responsible Investment. And I was encouraged to put my hat forward to go onto the board, which I did. And so I was there on the board for 6 years in the early days, and have now come back as the CEO in the last 3 years. So I'll stop there, Jolie. That was a bit of a whirlwind, but for me, it's all about the member. It's all about the person you're serving, and ensuring that we create a better retirement for them, and that means therefore thinking about these broader issues that could impact your ability to create the right outcome for them.
That's wonderful, David. I think we go through certain experiences and which kind of stays with us, and we want to kind of also drive that particular cause forward. And this is something, I mean, it resonates with me. Actually, I was kind of working on gender-based disclosures. I'm really grateful I could do it with the CFA Society India. And so the ESG disclosures that we worked on, now I write on these topics, and I invariably have to navigate this aspect of fiduciary duty. And now, on one hand, there is an economic value case to it, there is a moral case to it. But sometimes, if one just like looks at it without any preconceived lenses, the larger picture is that India is in the need to more than double its women's LFPR rate, basically the labor force participation rate, and in this decade itself. So if we want to aim for becoming an upper middle income country, so gender inclusivity is crucial anyway. So I feel that the organizations which are prepared for that kind of an enormous cultural change, they will invariably do better. And so there are so many demography related aspects as well, which are kind of intertwined with economic value as well. And so they also lead to similar conclusions, and it has kind of pointers towards preparedness for the future as well, right?
Mm-hmm. Absolutely. I mean, I think, again, if you're just thinking dispassionately, just putting aside the sort of, the social rightness of this, just in terms of economic value, if you're having to think about creating value and having your economy, be able to achieve or to deliver to its communities, you need to have as much talent. You need the talent pool in which you access is really important. And so if you've got barriers and impediments that are stopping key parts of your workforce from being able to fully participate in the workforce, then that's you're shooting yourself in the foot. And so I think we have seen over time, certainly in my lifetime, not fast enough, but we've seen women's access to the workforce change. We've also seen women's access to different professions change. We've also seen the fact that women are playing more and more of a role in senior leadership is also changing. I mean, it's why, for example, we're heavily involved with the 30% Club in Australia. With this, obviously it's an international group, and it's been focused on seeking to, because at the end it needs to start from the top. So you need to have your trustees, your non-executive directors. You need to have a balance of male and female to get the full gamut of experience and knowledge and expertise. And so within the Australian context, I think when I started in the roles, it's probably about 10% of the directors were women. And as we were probing the companies and engaging with them, saying we want to see an improvement in representation, I think it's now sitting at around 45% in Australia.
Wow.
Of the top 100 ASX companies. And that didn't happen by accident. That happened because investors engaged with those companies and said, we want you to see an improvement, a broadening out of who you consider. So, I think you can change this with concerted effort by proper engagement and signalling and programs to support training and development. So that's at the non-executive level. And Joe, I don't know if you want me to mention, but through the time that I was at CBUS, we were internalising some of our investment program. The traditional model originally was take the money from members and then hand out mandates to external managers. But we wanted to develop our own internal capability, and we started internalising our investment program. And when we started, we had only 1 in 10 applicants coming from women. And that really concerned us because we did not want a team full of investors who were all male. And so we ran a range of deliberate programs to encourage applicants, but also when we employed them, to make sure that they weren't just in junior roles, that we role model senior roles. And one of the key things that we did that really did make a difference was encourage men to take family leave when they were having children in their families, and having the senior men take family leave and then promote it so that everyone in the investment teams could understand that it wasn't a career threat. It was a career enabler, in fact, because it gave other people opportunities. And the men who were able to take that family leave were able to come back with so much positive stories. And I'm pleased to say that when I left the fund, 40% of the team were made up of women, and
Wow.
many senior women. There were lots of other programs that we did to get that result. But I know, just from a cognitive skill set point of view, having that diversity meant that we made better decisions as a result, which is, ultimately that's what we're here to do, to get the best thinking and the best skill sets to make the best decisions.
That's encouraging actually to know that journey, and it feels that okay, we can also traverse this in many ways because we are anyway in a cusp of cultural changes which are heading our way, because of a lot of Gen Z population is also going to come in the workforce, and the dynamics today are totally different. So that's really encouraging. Yeah. Okay, David, now coming to sustainable investing becoming more mainstream now, especially in the key financial markets. And as you mentioned earlier, also, materiality has come to the fore. So be it environmental, social, or even financial, basically, but it has come to the fore. So if you could kind of help us take us through the history and development of what this journey looked like.
Yeah. So what's interesting is when this thematic started, it was very much a niche idea, and as I said, I think the beginnings of it really starting to resonate was starting with the G, with governance conflict, corporate governance failures at the early turn of the century. And that led to a lot of establishment of forums and groups, like, again, in the Australian context, the Australian Council of Superannuation Investors was formed. It started with the G, and then it moved into the S, the E, and the S. And then organisations like the PRI, supported by the UN, it's often known as the UN PRI, was established in 2006. It was launched by Secretary General Kofi Annan at the New York Stock Exchange. And it was a set of 6 principles that some leader asset owners started to coalesce around, which was around recognizing that by integrating environmental, social, and governance factors into decision making could improve your ability to identify risk and opportunity. But also those principles captured the idea that signatories should share experience, learning, that they should be transparent about their activities. They should promote the thematic. And so, as they say, from little things, big things grow, because roll forward to 2024, the PRI now has more than 5,300 signatories in 100 countries, representing 128 trillion US AUM. And that is more than 50% of the institutional capital out there that have signed up to the principles. So this was a bottom-up response from the investment community, who recognised, going back to what I said earlier, that when they were thinking about value, that there was missing information, there were missing thematics that could materially impact the value of the companies. The other thing that's changed here too is that it's no longer just a publicly listed initiative. So it's not just public equities. It's now, most of our growth in the last few years is coming from private markets, from real estate, from infrastructure, from private equity. So it now covers many different types of investment strategies. But the driving force behind the PRI has been this recognition that the asset owners, the insurance, the pension funds and the insurance companies, the endowments, the sovereign wealth funds, even central banks, are at the apex of the capital allocation process. And if they form a view about what is important, they should be able to communicate that and establish mandates with their investment managers and through the ecosystem to create alignment. And so that's effectively what's been happening over the last 20, 25 years, is that this recognition of this thematic has grown. And now we're in a different phase where we're seeing this top-down architecture being put in place around the globe, because regulators and policymakers have recognised that that this is an important part of the changing financial system, and we need to make sure that there is accurate disclosure. Also, that we're getting sustainability information that enables investors to be able to compare and contrast, and ensure that they understand what the carbon footprint is of the company, that they understand what the gender approach is for value creation, that they understand the impact on nature and biodiversity, that they understand the human rights record. So all of these things are now very much part of the work of the PRI.
Interesting. So, David, speaking about the regulation, especially, I think earlier, there was a very big need of standardizing data and to address the risk of greenwashing.
Yes.
And now sustainable finance and regulation has really seen some dramatic increase in recent years. It is playing a crucial role in reshaping the entire sector. I guess SFDR also has gone through revisions, and I remember many Article 9 funds were revised to Article 8 from dark green to light green as a consequence. And I feel like there's a lot of ground in terms of the breadth and depth of disclosures, which has also kind of been covered, right? So, like, where do we stand? I mean, if you could help us take a stock of how far we have come on this front.
Yeah. So I think that as I said at the very beginning, this thematic is replumbing finance. And when I say replumbing finance, what we're doing is we're recognizing that there is missing information, that there isn't standardized information in the way that, it took many, many decades for the traditional ways of assessing the balance sheet to get trusted. And so there were processes and methodologies and frameworks that got you to the point that when you saw the balance sheet, you understood, yep, I believe that is the correct number. Well, we're not in that world just yet from a sustainability point of view, but it is changing fast. It's only 20, 25 years. And so now we've got the situation where IFRS have taken over a number of voluntary reporting frameworks, SASB, the Value Foundation, Integrated Reporting, etc., and have established the International Sustainability Standards Board, which in the last 12, 24 months are beginning to issue sustainability modules that can be used globally when for climate, for example. And so what's really pleasing is that we've now had, I think, up to 40 countries announce adoption of those ISSB standards. And so what that means is that when investors are looking at companies who have adopted, and those countries that have adopted ISSB, they'll be able to compare and contrast the companies within an industry in a country, compare country to country. And so then they'll be able to say, well, which are the ones that are giving this information that gives us comfort or we think are promising, which are the ones that we are concerned about, where we can engage. So the building blocks are being built out. Now, it's not complete. There's a lot more work to be done. But and I would also say that we're in an uncomfortable period right now because we're seeing the emergence of a range of mandatory and voluntary standards, which means that it feels like people in the space are spending all their time reporting and not spending enough time on taking the information as insights and in using them to invest. But I think this is just a natural period of time we're going through that we'll consolidate and we will get international standards, which will mean that where investors will have far superior information. The other thing that I think that's important to mention to your question or your point around greenwashing, I mean, it is natural. I think we went through a period of perhaps 3 years ago, a lot of aspiration and a lot of good intent, but also, people recognized that this was a major thematic. We need to get in there and sort of see whether we could find some opportunities. And so there probably was a little bit of looseness in claims that were being made or in terms of product. And for me, I've never seen this thematic as a product. I've always seen it as an investment belief and an investment strategy. So I think this is a natural process of interrogation to say, well, if all of these products are coming onto the market, let's look under the bonnet. Let's make sure that what they're describing is actually what they do. And so as a result, the regulators are naturally going to that work. But I think that is a natural and a necessary process of moving from being a startup, into a consolidated phase, into a mature phase. But I'm very excited about the way forward. We're now seeing, TCFD standards have now been captured in the ISSB standards. I think the next cab off the rank will be TNFD. And the next one that's just been launched is I never get this quite right, but basically it's the social indicator disclosures are also starting to come through as well, which I think starts to fill out the information investors will need to make truly informed decisions about responsible investment.
Absolutely. I guess disclosures have come a long way, and also there's some work which needs to be done on the taxonomy front as well, right?
Yes. I mean, again, what's really pleasing there is that, I mean, if you'd said to, what did taxonomy mean 10 years ago? No one would have known what you're talking about. But if you're now getting to a world where we've got capital that's wanting to get invested into green assets, or what is a green asset? And there needs to be a description about that's agreed to. And so what's really pleasing is to see how, again, around the world, we're seeing taxonomies being developed and issued in a way that's going to provide more confidence to investors about, what green is, what is a green investment, what is a transition investment. So I think, again, this is a very important building block that's being put in place.
Yes. Which activities fall in which aspect of the entire green economy? So very important building blocks. I guess TNFD adoption is also rising, right? There's a lot of attention now to biodiversity loss as well.
Absolutely. I would say the number one issue when we go around the globe that investors are wanting to educate themselves around is the fact that nature-based investing is seen as a very important part of, I guess, the challenge, but also the solution to us living in a world where we can have a sustainable economy, sustainable environments, sustainable societies. I think the majority of investments in the economy are dependent on a healthy world, a healthy biodiversity environment. And so what's been interesting to see is that increasingly investors have recognized that to solve climate, you must also solve the fact that we're depleting our planetary resources beyond what is sustainable. I think 6 of the 9 planetary boundaries have already been breached. And increasingly, people are recognizing the interconnectedness of these issues, climate, nature, but also the social aspect. I mean, you can't, people worry about stranded assets, but they also need to worry about stranded communities. If communities whose livelihoods were based on, fossil fuel industries, and therefore we start to see those fossil fuel industries being closed down, if there isn't a proper plan to enable those communities to transition, don't be surprised if there is a political response. It might not be, and it might be a populist response, but don't be surprised. And then going back to the question around TNFD, what's really exciting is that, while the nature piece is harder because it's not like climate, it's not a single number that you can work back from. There is a growing recognition of its interconnectedness. And so as we move into this back period of 2024 and we move into COP16 and COP29, the COP16 in Cali in Colombia in a few weeks' time, we will see the biggest representation of investors attending that COP who want to engage with policymakers around finding nature-based investment solutions integrated into policy. And I think that's a very exciting development.
Interesting. Also, the social license to operate aspect of it is kind of gaining acceptance amongst companies, right?
Absolutely. It's a social license to operate increasingly is being recognized by companies that, if it's all about pure profit and you don't think more broadly, then you'll have reactions from societies and from governments who will step in and take away that license to operate, which can, be quite material.
That's interesting. So there's a lot of, on one hand, acknowledgement from a lot of industry players, stakeholders even. And on the other hand, like now there are some tailwinds in the US that we have seen recently. What do you think about them?
So I think the US is a very important market. It's obviously the largest capital market in the world, dynamic economy. It's not one thing. So, there are as many positive examples that I can give you as negative ones, but it's definitely true that we have seen the politicization of ESG within some parts of the US. And I think, it's not surprising because, again, as we go back to this point, a lot of what investors have been trying to do is engage with companies that have got high carbon footprints and engage with them about how they're going to transition into a green economy, into a world that's decarbonised. And don't be surprised if some of those companies feel like their profits are going to be threatened or that they have to change the way they operate. And so they've been pushing back and they've been funding campaigns to attack the ability of investors to work together on these climate issues. And they've had some success, that is true. But if you step back, even the one that's been particularly in focus has been Climate Action 100, which is a collaborative initiative designed for, I think, something like 700-800 investors around the world, engaging with the high emitters and in a dialogue with them about their carbon footprints and their business models. We have seen some of the members of that initiative pull back because of the attacks from state legislators, attorney generals, etc., in red states in the US, which we understand why, because that no one wants to be in the middle of a political fight and litigation. Not that the allegations around antitrust stand up. Any of these initiatives that are properly established do not breach the laws of the land around antitrust, but no one wants to get caught up in the political process. Notwithstanding that initiative has actually grown in the last 12 months. It's had more members join than leave. And it's doing fine work as we start to see increasing positive changes in those companies that have been engaged, putting in place transition plans around climate. In addition, you've got some of the most progressive climate disclosure laws that have been introduced in California. You've got the Inflation Reduction Act that the Biden government introduced, which is providing massive subsidies to invest in renewables. And that is materially changing the way that marketplace works. So, there are positive and negatives. One thing that I would say, though, is that we are not, yes, the politicization of ESG is definitely an area of focus, and there's probably not a meeting I go to in the world where it is not raised. But as I said, there are positives in the US market as well as negatives. But everywhere else in the world, we're heading in one direction. The world is putting in place the architecture required to deal with the fact that our economies need to transition. And that's not going to change. And we're also going to have to recognize that we will go through different political cycles over the next 20, 30 years. And this is just one of those cycles.
Absolutely. I guess shorter term periods can have a lot of noises, but overall longer term period, as you mentioned, we are headed in that direction.
We're moving into, over the next 12 months, as we move into COP30 at Brazil, all of the countries have to come back with revised nationally determined contributions. And I think as the world is heating up and as we're seeing, the impact of climate really start to have much more material impact, the countries will have more ambitious and more aggressive NDCs that will, I think, start to flow through into company requirements. We're starting to see, even in some jurisdictions already, mandatory climate transition plans for companies. And so the more that starts to sort of move across the globe, everyone will therefore be judged, assessed by the market and by regulators around the effectiveness of your climate transition plans moving into the next 20 years. So that's why I say the world is heading in one direction here, and it's very clear.
Interesting. David, now zooming in slightly in PRI's role, and if you could help us understand how you work with your signatories, because on one hand, they have to navigate a balancing act between a long-term vision and the practical challenges of the shorter term. So if you could take us through how you work with your signatories and also in the larger sustainable investing ecosystem overall.
Yeah. So if you think about it, so we are an investor association. We're a registered charity in the UK, but we operate in 100 countries. There are the 6 principles that our signatories sign up to. And so our job is to help our members meet the principles, but also help our members achieve a sustainable financial world. So we do that by, first of all, helping you as an individual institution become better at what you do. So we have a whole range of programs of work, committees that our signatories form on asset class or on strategies or in geographies. We provide guidance, DDQs, reporting that enables you to benchmark yourself against the signatories. So that's all about helping you as an individual institution become better and more mature in your practices. But if you believe the thematic, you know you can't solve these issues on your own. What we're dealing here with is often systemic risk issues. So we bring signatories together, we create convening opportunities for them to work together on areas of common interest and have programs of work around climate, around human rights, around nature, governance, other ESG issues. Um, uh, and so we have a lot of initiatives like Climate Action 100, Net Zero Asset Owner Alliance, Spring, which is our nature initiative, Advance, which is our human rights initiatives. These are all things that are in that space. But again, if you believe the thematic, you know you can't solve these issues, even when you work on your own with other signatories, because we're operating in a world that's been set up for a previous economy, rules and regulations. And so part of what the role of the PRI to do is to advance the interests of investors to governments about creating more of an enabling environment for investing in responsible investment. And so a lot of our work is at the global policy level and at the regional policy level. In fact, I'd say that's probably one of the most important areas of focus that's come through our recent consultation with our signatories. And then the final sort of tilt is recognizing that while we're global, we need to operate in local markets relevant to the needs of the local markets. Because what the issues are in South Africa are different to Europe, are different to India, different to South America, where I am right now. And so we need to have resources on the ground to support signatories in their work. The other thing that I would say is that, to your point about global ecosystems, the PRI's role is to we are the one global organisation that covers all of the E, the S, and the G. We can't do everything, and nor should we do everything. Part of our role is to lead as well as get behind other groups already operating and partner and amplify their good work. CFA is a perfect example. We've worked with the CFA over many years in terms of developing the curriculum for the various ESG courses that the CFA provides. We also have our own PRI Academy. The courses are slightly different. But it's important that they're complementary and we work in a really supportive way with the CFA around the world, as an example. So they're just some of that's how I would describe what the PRI's value is to the market.
Absolutely. And while we are at it, I do know that I have myself gone through a lot of comprehensive reports that were jointly authored by the CFA Institute and PRI. So they were like really helpful in understanding the entire spectrum of it. And yes, CFA Institute also has some extensive courses, like one is on the ESG investing side, and then the other is on climate risk valuation and investing certificate. So they are also like brilliant resources, and they go a long way. I believe there's a lot of scarcity of expertise, right, in this space.
Can I just go to that point? Because sort of the theme of this conversation has been that we're in a period of change. Part of the challenge for our industry is that investment professionals have not been trained to solve these problems. And these are new problems. And so there is a capability and a training piece that's underway at the moment where we're having to develop new knowledge, new skills, new problem-solving tools, and we're also needing to bring different expertise into investment teams. You need to start to have, environmental scientists and biologists and so forth as part of the investment skill sets of our teams. And so I think there's a lot of opportunity here for new careers in a really important area of work within the economy. So yeah, but this is quite new, and it's a challenge because we don't have all of this talent we need to solve these systemic risk issues.
Absolutely. I think this gray space is growing very fast, and there's a lot of demand for these skills these days. Now, which kind of brings my attention to the emerging markets, David. Unlike the developed markets, especially the European Union, investor demand is not a big driving force yet in the emerging markets. But there may now, as the world has moved forward, there may be a top-down impetus, which is like kind of coming everyone's way. So, but the progress of this whole space will probably pan out a bit differently as compared to the developed markets. So a lot of capacity building may also be required. So how do you plan to work in this region? And probably, I think the learning curve that you've had from the developed markets with other stakeholders, I think that will also kind of help you in this space.
Oh, 100%. Now, that's the first thing to say is that the PRI has always had a footprint in emerging markets. Some of our founding members were from South Africa, were from Brazil, were from Southeast Asia. And we currently have about 650 members in emerging markets right now. However, in saying that, we've highlighted in our new strategy, which has 4 key objectives, that we want to focus our efforts on emerging and developing economies around the world. We cannot solve these sustainability issues without active, healthy, strong emerging market ecosystems. So we need to and will be investing more time and effort and more resources on the ground. We're seeing, I think, a lot of momentum in South Africa and in the African continent, in Southeast Asia, and in Latin America. Next year, for example, our PRI in-person conference, which is the biggest annual responsible investment conference in the world, will be held in Brazil, in Sao Paulo, in late November. We are wanting to put more. I'll be spending more time with the team in India. We've got about 40 signatories at the moment, but we know that there is growing interest, but it's still very nascent, and so we want to spend some more time with the ecosystem in India to understand the challenges and the issues, what support is needed. We've begun talking to regulators, and I think this is what's really important, is that the regulatory environment, as we've been discussing, is emerging and changing. And so from an investor's perspective, they really want to see a practitioner's perspective brought to the formulation of this regulation to make sure that it's as harmonized as possible, that, there's this interoperability, because capital is mobile. It will go to the places that it's most attracted, where it sets up the most attractive environment. And there's a frictional cost of having to operate across so many jurisdictions if they're not in sync. So that's a really important role we have to play. And again, that's why we want to spend some time, because we know within India it's changing. As you say, the market signals are starting to come through. I think this is a really important area of our focus. So emerging markets for us is one of the key priorities, putting more resources in, more policy work, getting into supporting what's already there, but also encouraging people to understand that this is part of a world development of the way investment is changing, and you don't want to miss the bus. And the final point that I would make is governments are increasingly recognising that they need private capital to help them make their energy transition, and those countries that put up the right policy environment will attract that capital. Those who get in first will be advantaged. And we're starting to see that race to the top begin. And it's important that, we are able to sort of share that experience and knowledge around the world with governments.
Interesting. So it's not just a top-down impetus, but then you're also seeing a bottom-up effort as well, coming from the private capital space, like the TCFT aligned reporting has been increasingly adopted, and there are also several green bond issuances coming from this region as well. So I guess those are some signs of things progressing in this front, right?
100%. We're seeing, I think while some of the emerging market developing economies are later to the party, they're learning more quickly because they're seeing what's happened in Europe. They've seen what's happened in the developed economies. And, there've been some mistakes, or there've been things that haven't quite worked. And so there's the opportunity to sort of learn fast. And I am seeing some of the most innovative approaches from regulators in the Southeast Asian market, who are learning very quickly, and who are reaching out to private capital to say, we've got these sustainability systemic risk issues. 50% of the world lives in Southeast Asia. We are not going to solve these problems if we do not have an ecosystem that understands these issues and have got the right building blocks that's going to enable private capital to play its part. But I think there's a growing, fast recognition of countries around the Southeast Asian region about this thematic and are learning very quickly and are adopting what works for their markets. So I'm very encouraged. I think that's going to be a very exciting period over the next 10, 20 years.
Absolutely. I think we are overall also going through a cultural evolution with social media and everything, changing things completely and changing how we are living our lives as well. So a lot of awareness is also rising in this space. That brings us to the end of our conversation. David, thank you so much for sharing insights with us. It was wonderful to have this conversation with you. And I think PRI is at the center of the sustainable finance ecosystem. And you're doing a crucial job towards bringing the collective of stakeholders together. So I really wish you all the best in your future endeavors.
Thanks, Jolene. Thank you for having the conversation with me today. I really enjoyed it.
Thanks, David.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.